So today we're going to talk about a company that recently IPO'd in April, so April 2021, a company called Darktrace, right? So an interesting business because they're involved in cybersecurity and defense, and they have an AI system that allows them to do that. And what's interesting is they recently won an award in SC Europe, which is an industry-known award for cybersecurity, and they won the award for best security business. So they're obviously doing some good things and making their mark in the cybersecurity world. Now, they were recently in the headline. This is interesting about this company. They were recently in the headlines because a well-known entrepreneur by the name of Mike Lynch, who was the CEO and founder of Autonomy, he sold his business for about 11 billion to HP. Now, there's some controversy around the valuation, and HP are accusing him of fraud, etc. Nothing is proven, but there is some controversy. Now, the reason why is because he's connected to Darktrace. In fact, his family funding company, his private equity business, owns around 16% of the shares. And actually, they were saying that they were nervous about that connection. Not they were nervous, but there was knowledge in the market that there might be some nervous about that connection, which actually reduced the valuation that they went for on the IPO. So even though they raised 165 million pounds on the IPO, it's still about 1 billion pounds less than what they were hoping to be valued at. And there is some connection there with Mike Lynch, which rumors say has caused that. So this is an interesting business to look at, another technology company that is yet to be profitable, but that hasn't stopped its share price from being 40% up from the IPO. And we want to thank Dipesh Mistry for recommending and requesting for us to look into this company and analyze their finances. So Dipesh, this is for you. So Ted, let's share what we found out. But before we do so, just to be clear, please like, share, subscribe. And if you want us to analyze a company for you, leave a comment in the comment section below, and we will do that for you as we're doing for Dipesh right now. Remember, this is analysis on the fundamentals of the financials. So before you make an investment decision, make sure to do your research about all the other areas that are important for you to make that decision. We're just looking at one part, which is the financial analysis here. So Ted, let's share what we found out, because there's some very similar things with other technology companies out there in terms of their valuations, but it's a good business to look at, right?
Absolutely. So thank you very much, Moeed. And yeah, let's just jump straight into the financials. Now, quite difficult to find the financials for this company, unfortunately, because it has recently IPO'd. So we have to use the prospectus. So let's pull up the prospectus. Here it is. So this is the Darktrace prospectus. There's a whole lot of or kind of limitations on the front few pages. And then if we want to actually look for the numbers, we're going to have to dig all the way through the prospectus to page 106. So you'll notice a lot of information in this prospectus. If you are an investor or you're looking at investing, as you said, it's worth doing your homework. If you are what we call a value investor, you really want to understand the business rather than just, you know, a momentum investor or a growth investor where you kind of just go along with the wave. That's a kind of different approach. But if you are looking at valuing investing and want to understand the business, then we're going to give you the numbers, but you need to go out and do your own homework on, you know, the market size and the potential and the reputation and the contracts that they've signed, etc., etc., etc. Okay, right. So enough of that. So let's look at what is happening in this company. So the first thing we notice here, now we've got numbers of sets of we've got quite a few sets of numbers up here. So these numbers on the right are for the year. And then what they've also given us is for the 6 months as well. So what they're trying to tell us is that, you know, here we are, what are we in, sort of nearly the end of June. So nearly the end of June 2021, the numbers are going to be coming out relatively soon. They're obviously going to, you know, they've got to close the year end and do all the audits and so on and so forth. So we're probably about 3 or 4 months away from the year end. And so what they've given us is a kind of an update on the prospectus for the 6 months since the last audited figures. So in that case, what we're really going to focus on is we're going to look at the latest set of year numbers. I'm going to compare them with the prior year, and I'm also going to look at the latest 6 months and see if that latest 6 months continues going. If they do in the second 6 months what they did in the first 6 months, what is it looking like? So that's kind of, you know, what I'm looking at. But, you know, you might also want to have a look at, you know, sort of 3 years ago and comparing this 6 months to kind of last 6 months, etc., if that makes sense. So what do we see? So first of all, we notice that sales are growing. Okay, sales are growing rapidly. Here we go. They grew from 2019 to 2020. They were up 45%. If they deliver on if you double this number here, you've got another 27% sales growth. So very, very strong, rapid sales growth coming in for this company. We also notice that the cost of sales is really, really low. Okay, so these guys are basically selling software. Now, I'm guessing that that's going to be some software development costs in there, but those are very, very low indeed. So these are in millions. So you got 126 million of sales, 12 million of development costs. The year end, 30th of June 2020, 200 million of sales, 17 million of costs, and that for 2020 is a 91% gross margin, which is very, very high indeed. So this is looking pretty nice. We like a good juicy margin like that. Although, you know, if they don't have the right product, there'll be other people who'll be trying to get in to get some of that aspect as well. What's interesting here is they then give us the kind of the SG&A, the sales, general and administrative costs. They've kind of broken it down a little bit between the sales and the marketing and the administrative. And I think there's a story they're telling here. So first of all, they're spending a lot of money, 163 million on sales and marketing. So this is a very, very strong push. They're out there, they're pushing this, they're marketing it. They're actively really pushing this into the market. And I guess that's a good thing. You know, that's good for us because, you know, if you're an investor, you want your product in everywhere. It's on everybody's lips. Quite a lot going on in research and development as well. They obviously want to highlight that to say, look, you know, we recognize that, you know, this is at the forefront. You think about some of the cyber attacks we read about oil being cut off from parts of America, etc., the ransomware that people are starting to pay. So you need a significant amount of development because, you know, the hackers, they will be developing their own responses to this. So it's a bit like an arms race, and you do not expect that number to go down at all. In fact, you can see that for the full of last year, they spent $12 million. And for the first 6 months of this year, they've spent nearly $11 million. So we'd expect that to double up to $22 million, for example. You're right, we are loss making. Okay, so here we are loss making at the bottom. We haven't managed to break even. They're not that far off break even, actually. So if we think about the gross profit that they're making, so this gross profit here, 181 million, compared with the operating costs of 206 million, they're not that far. And on a gross margin of 10%, it should be relatively soon. However, you can see if this number doubles, then you're going to end up with, you know, just short of 100 million loss in the year. Okay, so, you know, what we're seeing is that these numbers are, you know, the costs are growing as quickly as the business. As I highlighted this R&D, for example, they've got some, you know, other administrative expenses in there, 21.5 million, 26 for the whole of 2020, and already they're practically there. So, you know, they're growing rapidly. They are expanding. You know, at some point we really need to start to see them putting the profit on the bottom line. Let's take a look at the balance sheet, see how strong their position is. So here is their balance sheet. Once again, we've got the 6 months on the left, and then the kind of the 3 1-year balance sheets. and we're really interested in their current positions. So for our sake, our purposes here, we're interested in this column here. This is the latest view of the business. What do we see? Non-current assets, things we need to run the business. 111 million. Hasn't really changed. It's been, you can see it's been growing steadily over the years. We'd expect that. And for the current assets here, big rise to 186 million, and most of that rise is coming through cash and cash receivables. So if you're loss making, I'd expect that they've been raising some additional financing in order to fund their business. We'll confirm that a little bit later on, but pretty strong cash position there, a decent number of current assets. What we might want to do is to compare those current assets to the current liabilities. So there are the current assets. So remember, current assets, things that we own or which are going to become cash or already are cash. And these are the current liabilities, the things that we have to pay soon. Now, on the face of it, that doesn't look too healthy. And that's a bit of an alarm bell until we actually examine the current liabilities. And a lot of the current liabilities, in fact, most of the current liabilities, is this thing called deferred revenue. And deferred revenue is revenue you've received but not yet earned. It's a timing thing, not a I'm going to have to pay it at some point. So in effect, their business model is you pay today to install their software onto your systems, and then they provide you the service over the rest of the year. So that's a very good business model, and it means that they will have very, very strong cash flow. So we can ignore the deferred liability because this isn't something they're going to have to pay back, unless of course they close the business, in which case it's irrelevant, and therefore we're really comparing the current liabilities, the current assets to these numbers here, and we see that their current their liquidity ratio is fine. So it's all looking good. Look at the bottom half of the balance sheet, see what's happening in terms of how they're funded. So they're funded through the non-current liabilities, which is generally the debt and the equity, and we see something quite interesting down here. So if you just remember, you can't see the column headings, but if you remember, so this column here, so this column is for the full year. This is the full year previous year, and the full year a couple of years ago. This is the 6 months, and this is the sort of comparative period of the previous 6 months. So what we notice, first of all, is at the end of this 6 months, they've got this whole lot of debt. Okay, they've got this convertible loan, okay, which didn't exist before. So there's a lot of debt now sitting on the balance sheet. And that is also reflected. We'd actually picked that up beforehand if I'd mentioned it. Apologies that I didn't. So we can see that jumping out at us in the income statement in this figure here. So you can notice that while the R&D, for example, they spent in the first 6 months, they spent almost what they spent in the last year. For the finance costs, you can see those have gone up very, very dramatically. So from 2.4 million in interest to 43 million in interest. Okay, now that's a big driver of this business, and that's a big driver of this loss as a result of that 43 million in finance costs. And that finance cost is because they have now issued a ton of debt, as we can see sitting on the bottom of the balance sheet. 43 million on 200 million of debt. That's pretty high to me, but that's what it is. And what we see down the bottom in the equity is that while they finished the year with 170 million of equity, that has now since fallen to only 44 million of equity. Okay, so retained earnings down here, this is where they're making a loss and they're piling that through there. There's a little bit of other kind of, so there's some stock compensation, translation on Forex, but this is really the interesting number going on here, which is showing us that effectively they're doing a equity for debt swap, i.e. they are issuing debt and using that money in order to buy back their shares and to reduce the equity in the business, which I think is quite interesting and may also be a reason for driving the share price, perhaps. Okay, so what have we found? So just to summarize, rapid growth in sales, the split of expenses is telling the story, big increase in finance costs, non-current assets is flat, current assets, they've got more cash than they started with, lots of deferred income, so they're going to be generating lots of cash, which will be good in their cash flow, but there is a debt for equity swap, i.e. they've issued debt and used it to buy equity. So let's go and have a look at the cash flow and see if this is kind of, you know, if it's all tying up and making sense. So up at the top of the cash flow, we can see the loss that they're making, they're booking each year, for example, as we'd expect. And if we go down, just scroll down a little bit further, we can see the operating cash flow. And what we notice here is that they are generating cash. Look at this. Last year, by June 2020, they generated $23 million in cash, and already for the first 6 months of this year, they've managed to generate $19 million. That's almost as much as they did in the previous year. So very, very strong cash generation, predicting something like, you know, what is that, 50 million of cash if they can carry on with that kind of, or 40 million of cash if they can carry on with that kind of performance. Scroll down a little bit further and we get the full picture. So there's a little bit of working capital movement going on here, and you'll notice that the working capital movement here affecting the cash flow, big number again coming in, this deferred revenue. So you've got the salespeople out there, they're closing the deal, they're signing the contracts, they're getting the money in today, and they're going to earn the money over the forthcoming 12 months. So the harder the salespeople work, the more they get in cash and deferred revenue, and the stronger their cash flow. Okay, so you know, a growing company like this is actually going to show very, very strong cash flows. Once it starts to mature, those cash flows are going to look less strong, if that makes sense. But it's still a good business model. We like cash generation. Okay, scrolling down, what do we see? So in terms of what are they doing with that cash? We've got the cash from the investing activities. So little bit of investment going on, not a huge amount. So we can see end of last year, they spent, what is that, about $20 million on property, plant and equipment. They're only spending 16 million. I think it looks to me like they bought all the kind of computers and servers and other bits and pieces that they need. They don't really need to do a huge amount of investment. It's not a capital intensive business, being a software business. And then the financing, here we can see, so the financing, really the numbers that are jumping out at us are these two numbers here. So in effect, the repurchase of shares, and that confirms how the equity invested in this business, they've been buying back their shares. They'll have done that before the IPO, so you know, it's not going to be affecting the share price in the market. This is before the actual IPO happened. They were buying back their shares, and they were, you know, really turning it into these convertible loans. Now, what's interesting here is the convertible element of this. So what they've done is that they've reduced the number of shares. They've then gone to market, so there's a reduced number of shares. Hopefully, those shares are worth more. But what they've done is they've converted it into a loan. So that loan is now sitting there, and that loan is convertible into equity should they so wish. Now you'd have to look at the details, and I haven't looked at the prospectus in detail, so there may be the details of that convertible loan in there. But is it convertible at the behest of the company? Is it convertible at the behest of the borrowers? Do they both have to agree, for example? And what are the terms of that loan? 43 million of interest on a loan of I think the total debt was about 200 million. It seems to me very, very high indeed. That's 25%. I reckon you could get a little bit better than that in your bank. You can probably get better than that in your credit card, actually, which is meant to be high risk anyway. So it looks a little bit, you know, I'm interested in that. That's a little bit of an alarm bell, and I have to admit I haven't dug into it any further, but that's the sort of thing I'd want to go and have a look at in a little bit more detail to find out exactly what is going on, who who has lent that money, what are the terms of that loan, and can we find out anything else. You'll notice it does give us a note 28. We might just go and have a look at note 28 and see if there's anything in there that tells us more about that convertible loan note. So here we are. So it's not 28. So we did look at note 28. 28 tells us to go look at note 22. Here's a little note about the convertible loan notes. And there we can see these convertible loan notes. That's a high rate of interest. So it'd be interesting to know who actually owns those. They've converted the equity into these convertible loan notes. Did they need to? I'm not convinced that they did. They already had the equity, so they've effectively taken out these loan notes, used it to reduce the number of shares, and now they're paying 18% to the issuers of those loan notes per annum, compounded monthly if they are if the convertible loan notes are settled in cash. So quite an interesting kind of business model there. Looks to me like maybe some of the existing investors are, are maybe feathering their own nest. I obviously, that's a speculation from my behalf. So that's I'm happy for someone to put me right in the comments. So let's go and have a look at their share price and see what the share price tells us about the company. Here we go. So the share price haven't been so recently floated, so not a lot of action in the share price. It's been going up. So if you were in at the IPO, then you've made a little bit of money, which is pretty good. It's trading on 3.43 billion. Just to note that that's pretty much all goodwill. It's 23 million on the balance sheet at the end of 2020. So that is pretty much all goodwill. The balance sheet has actually gone negative because of all the debt by the end of December. So effectively that is 100% goodwill, or 100 over 100%. They're trading on, there's no PE ratio because they're making a loss. They're trading on 17 times sales. I would suggest that there's a lot of good news in this company. It's all baked into the price. It's very expensive. It's got to deliver on that. And I'm just nervous about that convertible loan note. Something doesn't really make sense there.
Yeah, I would agree. It starts off very well with the 91% profit margin, gross profit margin at least, and you think, wow, that's even for a technology company, that is especially high. But we've got to see whether their investment in sales and marketing actually pulls some sort of results and profitability in the future. But I agree with you, those convertible notes, a little bit nervous about that, especially with such high goodwill as well. What is that going to do in terms of the profitability and the share, the equity and the dilution of the equity? So interesting company to see, and would love to hear the comments from our viewers, right? What do you think? Is there anyone that's involved in cybersecurity or an expert in this market? Maybe you can shed some light for the rest of us. And if you have some deep knowledge on maybe some of the reasons behind those numbers, that would be great. So as always, leave a note in the comment section. If you want us to look at a company for you and analyze it, do let us know. Like, share, subscribe as always. And until the next video, thank you, Ted. This was an interesting one.
Excellent. Yeah, good to speak to you, Moeed. See you on the next video.